My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found at some of the largest proprietary trading firms and hedge funds in the United States. 21 trading tips from Paul Tudor Jones, part 4. Tip number 16. When I trade, I don't just use a price stop, I also use a time stop. This is a really interesting point because most people think of trades just in terms of price. But when we trade, there's actually two factors to manage. There's the factor of price and there's the factor of time. Price is obvious. Trade goes in your favor, awesome. It goes against you, you're losing money. Time is not as obvious. It's especially not obvious to traders who are mentally attached to their trades. See, the reality is every trade has an opportunity cost associated with it. Capital that's tied up in one trade could easily be allocated to another idea. The concept of opportunity cost is actually always weighing what I'm invested in better than what I could be investing in. The concept of opportunity cost is one of the most powerful factors in successful trading. Really great traders are always evaluating, is what I have on, is there something better instead of the trade I currently am in? One common theme you'll see if you go through and evaluate your trades is you'll see that your best trades tend to work right away. It doesn't take very long. It's very rare that you get in a trade and you're down money and you wait and you're down money and you fight and you struggle and then it takes off. That's actually very rare. Your best ideas will work right away. So the data will show this. So one of the things you do is you go through and you look at your trades and you see how long did it take for that trade to work. And you'll see that your best trades don't go very far against you. They just go. Your worst trades will go against you and they will stay against you. So the general concept is if our best trades work right away and they don't go very far against us, well, then the longer we sit in a trade that isn't working, the less likely it is to work, the less likely it is to make money. So what a time stop does is it ensures that we don't waste not only our capital, but also our time. It ensures that we don't waste our time watching and putting mental capital into a trade, and we don't waste our capital being tied up in margin or usage. One of the things we've talked about is you can always get back in. So one useful idea is to have a time stop. Set up the expectation for the trade and say, if this trade works, it should work in 3 days, or it should work in 2 weeks, or should work in a month, or whatever it is. You set an expectation of when you think it should work by, and then you can actually implement a time stop where if it doesn't work in that period of time, you'll start getting out. I'm a big believer in using options. I love using options, and specifically, I love using long option structures. The biggest issue when people are long options is that the time works against them. They're paying theta to hold an option. So the longer they sit in it, the more theta they pay. If you use the concept of a time stop with options, it can be very powerful because I can put a trade on that says I'm bullish and it should work in a week. If it's not working in a week, I'm going to get out. Well, then I'm not risking the entire premium. I'm just risking 1 week of theta or 1 week of the time premium associated with this trade. If I can do this, this makes my R, it makes my reward to risk ratio really take off. 17, don't focus on making money. Focus on protecting what you have. This break-even curve chart, this is one of the classic tables, classic charts of all time. And it basically shows if I have a drawdown, how much do I need to make back to get to zero? So you can see if I have a 10% drawdown, I need to make 11.1% to get back to even. If I have a 15% drawdown, I have to make 17.6% to get back to even. If I have a 20% drawdown, I have to make 25% to get back to even. And you can see as the drawdown gets deeper and deeper, the level of recovery that's needed gets bigger and bigger. At 40%, I have to make 66.7% to get back to even. At 50%, I have to make 100% to get back to even. This is why we have to be very focused on protecting what we have, because a big drawdown is a killer. It makes it very difficult to recover from. Now, we'll take a different approach with our profit capital for a variety of reasons, but our initial capital, that money that you worked so hard to save, you've got to fight to protect it. That was one of Paul's big premises. He's always focusing on minimizing drawdowns and playing defense. Because if he can hang around, he can come back tomorrow, he's going to have a chance to make a lot of money. 18, you always want to be with whatever the predominant trend is. This is a direct quote that Paul sent me an email. 5 great ideas make every year, and they are all trend trades. Read that again. 5 great ideas, another 5 trades make his whole year. And every one of them is a trend trade. This is really important to know. Paul, ironically, learned this lesson the hard way. Paul had a belief that markets move sideways 85% of the time, and Paul was great at fading new highs and new lows in that type of environment. In fact, he was famous for it. He had his greatest trade of his career when he shorted S&Ps and bought bonds based on an analog on the 1929 stock market crash. Having this belief that new highs were made to be sold and new lows are made to be bought, and having this analog, Paul tried to pull off the same feat, shorting the Nikkei 225 in Japan in 1988 and 1989. And he quickly found himself in the biggest drawdown of his career. To date, it's still the biggest drawdown of his career, where he lost 20%, and he was despondent about these losses. He really started to question if he even knew what he was doing. Now, what's interesting is one of his traders who worked for me in later years, he told me this story, and he had told me how Paul was so upset, and Paul said, I need you guys to come help me figure this out. So Scott, who traded for me, Paul had Scott come in. He goes, I want you to look at these trades, and I want you to help me figure it out. So Scott did. And they went through all of Paul's trades, and what stood out to Scott was he's like, every one of your trades is fading the trend, and they're not working. So Paul agreed with them. And they went and did more looking into this. Out of this research, Paul came to the conclusion that he needed to be with the trend. They needed to be far more selective when he faded a trend. And what he did was he instituted a rule that said from that point going forward, 2/3 of his positions had to be with the trend. And this is a rule that he has lived by ever since. So he can have some trades that fade the trend, but the predominant balance of them needs to be with the trend. This is something I have seen in my own career. It's the big money is made trading with the trend. There's a handful of times the market gets extreme and you can make really good money fading the trend. But in general, the big money is made being on the trend. Big trends make big money. I want you just to think about with either you or somebody you know, I bet you know somebody that's made big money in crypto, whether it was in 2017 and 18 or it was in 2022. I bet you know somebody who's made big money in crypto. Why were they able to do this? Were they a genius? Were they a great trader? No. They were just on a great trend. So if you can separate our egos from this and just look at it, we will see that big money is made in the trends. So let's just go find the trends. Number 19, my metric for everything is I look at the 200-day moving average of closing prices. Very simple. Since Paul is committed to having 2/3 of his positions to be in alignment with the trend, the easy way for him to monitor this rule is to only be long markets that are above their 200-day moving average and short markets below their 200-day moving average. If you were to institute this simple rule, it would keep you out of a lot of trouble. So just buy above the 200-day, just short below the 200-day. Keep it very simple. 20, at the end of the day, your job is to buy what goes up and sell what goes down. So really, who gives a damn about PEs? It's about price to earnings ratios and stocks. There's another quote. It's just the nature of a rip-roaring bull market. Fundamentals might be good for the first third or the first 50 or 60% of a move, but the last third of a great bull market is typically a blow-off where the mania runs wild and prices go parabolic. He is so right about this. This is why so many fundamentalists really struggle. Fundamentals are great. They're a core aspect of how I think about markets and how I structure trades. I want to have the fundamentals and the technicals lined up. But I also know the market can be completely irrational to the fundamentals, but it always trades to its technicals, especially over any length of time. Great trends become irrational in their late stages. Massive amounts of money can be made in the last third of the trend. So fundamentals will say, well, this trade is getting overvalued, but it'll keep going. If price action is validating the move, then you want to keep trading the trend. The more extended it gets, the more hypersensitive you want to be to exit. And we love exiting into extremes. But there is a lot of money made in the last third of a trend. And so we don't want to just walk away from that. Another aspect of this is anytime a market can make all-time highs, something major is going on in that market that fundamentalists do not see. It is a big deal when a market trades to all-time highs. It is a big deal when a market trades to multi-year highs. Same for lows. This is something that we're constantly watching. So many people love to fade a new high. Oh, this is too expensive. That's how you lose a lot of money. We don't want to do that. We want to recognize that if a market can make new highs, people who know a lot about that stock or a lot about that commodity clearly have a different view, or they wouldn't let it make new highs. I want to share a quick story with you about George Soros and Stanley Druckenmiller. In the dot-com boom in 1999 and 2000, they had done their fundamental work and they were looking at these dot-com stocks and they were like, this is just stupid. These stocks don't make money or they traded insane PEs. And so they made a list of the ones they thought were the most overvalued and they started shorting them. And they shorted them and they didn't work. They kept going up. And so they shorted them and they kept going up. And finally, one day, George just looked at Stanley. He's like, you know what? There's clearly something going on that we don't see. We've got this all wrong. We're covering our shorts and we're going long. And they did. They abandoned their fundamental analysis and they pivoted and they went long. And they killed them being long. It's a classic example of not being attached to our positions, not being attached to our opinions. They just pivoted. They got long, and then when the market started to fall apart, they got out. They made 35% on that rally on big, big money because they just decided to go all in and go with the trend. This is very much what Paul is talking about. I've given you 20 tips, but I want you to notice this series has been called 21 Trading Tips from Paul Tudor Jones. Didn't say 20 tips. You have only been exposed to 20 of the tips. And guess what? Tip number 21, the final tip. It is the best tip of all. I'm going to have a special webinar where I'm going to teach you about tip number 21 and how to incorporate it into your trading. Tip number 21 might be the most important trading advice that you ever hear. I'm not kidding. Tip 21 might be the most important trading advice you ever have heard. I have incorporated this in my own trading, and I've incorporated this in with all of my students and traders I've trained. And this one thing makes a massive difference. It has the power to radically improve your trading. I know you want to come. I know I've got your interest. So see the comments below for the details on the upcoming webinar. You won't regret it. And what day is it? Yeah, it's Tuesday. But it's not just any Tuesday, it's Trader Tip Tuesday. On Trader Tip Tuesday, I come to you with different tips and tricks and insights that help you take your trading to an elite level. I will see you next Tuesday.